We're off the lows. Dow seeing its biggest drop in nearly a year. It's still around 700, 665 or so. All of it coming after that hotter than expected CPI print. With me now, Rich Saperstein of Treasury Partners. He's one of this country's highest rated financial advisors. Your phone's ringing off the hook today, I bet.
Not really, but it does. We have outbound calls we're pretty active on.
Yeah. So what's your read here? What does this mean for the rally?
Look, stocks are selling at 20, 21 times earnings, and in the last 25 years, it's only occurred 2 other times during post-COVID and .com. So right now, the market is priced for a tapestry of perfection, meaning declining inflation, accommodative Fed actually making cuts, low unemployment, and continued fiscal stimulus, as well as achieving 245 in S&P earnings this year. So there's a lot of good things that have to happen to keep the market where it is. You get a day like today where you have one data point that disappoints and you have a market sell-off.
Yeah, but you're ripe for a sell-off. Why do you need so many good things to keep things going? I would actually argue it's exactly the opposite.
Well, any one of those can go wrong, and the market's going to take it as an unhospitable act. So the market will sell off.
I know, but we've been up a ton. So, yes, it's going to sell off. But does it change how the bulls should think about what this rally has done and what it might do from here?
No, I think that we have to look at the market over longer periods of time. So the S&P over the last 2 years is only up 5.5%. The mags are up 17%, and the non-mags up 2.5%. If you extend your outlook over 10 years, the earnings are up 100%. The stocks are up 125%. So if you have a long-term view and you get a pullback, that's the time to add names that are attractive to you.
So what are you currently doing?
Well, we like the large technology names. If you take, let's say, Google and Microsoft and look at their cash flow in 2019, they generated $55 billion in operating cash flow. Last year, it was $104 billion. So their cash flows increased by 90% over the last 4 years. Now, Microsoft's up 150%, and Google's is up, 115%. So the multiple of the cash flows have gone up a little bit more than we'd like, but at some point, those stocks will come back, and it's important to follow the cash flows. The cash flows are growing tremendously year in, year out in these higher technology names.
Wait, so you don't think that the mega caps are overextended? I mean, you're in Apple, you're in Alphabet, you're in Microsoft, and you're in Amazon.
They're overextended relative to the cash flows. I don't want to make an argument that they're cheap, but if we look at the price to growth ratio, meaning these stocks are expected to grow at 20% this year, and the PEs are 30. So it's a 1.5 times PE to growth ratio, or a PEG. If you look at the non-mags, they're selling at roughly 3 times the price to growth ratio. Their expected growth is 6, and they're selling around 16, 18 times earnings. So relative to the non-mags, the growth and the multiple of the mags still put them in an attractive area, especially for a long-term investor that has an opportunity to add them after they've pulled back to more reasonable levels.
But should I keep riding the mega cap stocks or go broad?
Well, you're talking to somebody that's owned them starting in 2011 and has them in teens. So I'm a long-term holder of large cap tech that generates copious amounts of cash flows. Keep in mind that these companies have moved from cyclical to structural, meaning they used to be, I want this technology. Now it's a must-have technology across all industry groups. So there's less volatility in the demand for these services that they're providing. They're also buying back stock. There's an AI push that will occur over time. Mm-hmm. So there's tremendous, long-term reasons to own the large cap tech stocks that are generating cash flows.
Well, then you can't one cannot make the argument that you just made then, and in the same breath say, well, the market's too narrow. You just told me all the reasons why it should be narrow, correct?
Yeah, I don't have a problem with the fact that 30% of the market is in large cap cash flow generating equities. Now, that doesn't mean we own any of the smaller cap technology stocks. If you look at the last 2 years, compare the Qs versus ARKK, you have the ARKK over the last 2 years is down 30%, but the Qs are up 25%. So when we talk about technology, you have to separate between the large cap cash flow generating names versus the smaller cap, sometimes cash bleeding names.
What's the most actionable thing on your screen? I mean, you liked munis. What's the thing that jumps out to you, whether we're having a day like this or not?
Well, I like the fact that rates are higher because for our clients where the return of capital is more important than the return on capital, and we have a shot at buying long-term munis at 4.5 tax-free, that's a great opportunity for us because we want to own long-term munis for many of our clients, especially because in the long run, we see the economy slowing, and that will lead to lower rates, and that would drive bond prices higher. Now, on the equity side, we're still overweight oil. Granted, we thought global tensions would lead to a spike in oil prices, so it's surprising and it hasn't happened. But here's an industry group that represents 4.3% of the S&P, yet it's generating nearly 9% of S&P earnings. So there are names there that are attractive. And on the technology side, you mentioned the names, whether it's Google, Microsoft, Apple, these or Amazon. In the long run, investors who don't own these names should own them because if you got a long-term holding period, let's say 3, 5, 10 years, they're going to continuously grow their cash flows, and they represent foundations in portfolios.
I appreciate the time, Rich. Thank you. We'll see you soon. Rich Saperstein, Hightower Treasury Partners, as you see there.